Hello and welcome to Global Market Outlook 2016, a special series that we bring to you each year from the City of London, talking to a lot of prominent fund managers and market speakers about their outlook into the new year. Joining me today on the special edition is Keith Wade, Chief Global Economist at Schroders Investment Management. Keith, it's great to have you. Thanks very much for taking out the time again.
Okay.
Looking into 2016, staring at the crystal ball, what is your expectation? Could 2016 be a bit more certain in terms of direction than 2015 was?
Well, you would hope so, but I know that inevitably as we get into next year, we're probably going to have a lot of the same uncertainties emerging. And one of the problems has really been that the overall rate of global growth has just not been that strong. It's been quite a fragile economy. We've called it the sort of wobbly bike type economy, and it means that if there's a shock, then it could easily get knocked over. And I think the world economy is still a little bit like that. Going into next year, actually, some of the near-term indicators are quite good. The purchasing managers' indices around the world have improved, and it looks like the inventory cycle's turning. We just had some strong jobs numbers in the US, so that's quite hopeful. And we would expect to see some stimulus from China coming through as well, which would probably help to lift things, and sentiment towards China would change. But looking further out into next year, my concern is that the boost that we've had from falling commodity prices and oil, which have helped economies like India, but also Europe and the US, that's going to fade. So that would be another sort of support for growth that's going to gradually fade away. So I can't see it being a terribly strong year for growth.
So while you're saying that the support that we've got from lower commodity prices would fade away, would that mean that the situation would be pretty much at the bottom of of the growth cycle, wherein a recovery may not be may not be seen for certain, but there would be perhaps no more downside risk to the economy from here? That we would labor around a lower level of growth.
Yeah, no, I think we will. I think we will level around a lower level of growth. I think the thing about the commodity price cycle, though, it really needs to see supply side changes, I think, to really make a difference there. If you think about the oil price or what have you, we need to see much more in the way of cutbacks in production, particularly say in US shale. We need to see some of the big mining companies still reacting and cutting back production. But the underlying problem is still one of demand deficiency, so that hasn't really changed. So commodities might begin to improve now a little bit, and that would obviously help quite a lot of emerging market economies. But the underlying picture is it's difficult to see exactly where the strength of growth will come from. That's the problem.
Yeah, and a part of that story is push in investments, which has not really started world over, especially among private companies. It's largely being fueled by the government, and public investments are pretty much spearheading the way. Do you see that changing as well? Do you see business confidence coming back, wherein companies start investing and that shows up in corporate earnings?
It's not coming through just yet, and a lot of the indicators are suggesting that the business investment is slowing down a bit in the US. It might be a little bit better in Europe, and it might be a little bit better in parts of Asia where it's been very weak. We do see a few signs in tech, for example, that orders are beginning to pick up in parts of the Asian economy, but generally I think the outlook is still a difficult one, because if you think about China, for example, it's got too much investment and too much spare capacity, so it's got to cut back in that area. In Europe, you're still at an earlier stage of the cycle, and then in the US, where you'd hope to see more investment, the recent indicators have been quite negative.
And what would that mean for the US economy, its underlying strength, because that's where the worry is, and I think that's top of the mind for the Fed as well. What would that mean for US equities, which have rallied ahead of the rate hike decision and in anticipation of a strong recovery, as also what it would mean for the dollar?
Well, I'll start with the dollar. I mean, it's supportive for the dollar. We have seen the rally in the dollar. I think it is supportive. Although if they move rates and then give it a very dovish spin, then the dollar might lose a little bit of momentum, because it's a sort of buy the rumour, sell the fact kind of story. For the equity market, as I say, if people feel reassured that this means that growth is going to be good, then the equity market should do okay.
It's already done really well this year.
It has done it very well. Our concern is that the PE on the equity market now is getting quite high, and so there's a lot already priced in. So we've actually been preferring non-US equity markets and been rotating away to those at an earlier stage of the cycle. So it could mean that we don't see quite so much from the equity market in this environment. The equity market's relied very heavily on the Fed to support it, really, through providing supportive policy. So that may begin to fade away given where the market is.
And what about US growth? Will that sustain? Because we're looking at 2.5% this year. Is that likely to pick up?
I don't think it will pick up very much, actually, because the oil dividend that supported consumption this year is beginning to fade away. So, I think, we get a little bit more consumer strength in the first quarter, but then it gradually will fade away because inflation is going to be rising next year as the oil price effects drop out. Wages not really accelerating very much. There's not a lot of real income in the US economy to drive the consumer forward. So, I find it quite hard to get numbers much above 2.5% for growth next year.
And that just brings me to the other important story, which has pretty much dominated trade all of this year, and that's been China. First it was led by the commodity sell-off, then all that talk about the yuan devaluation, the stimulus support that the central bank is extending out to the economy, and by itself the state of the economy, whether the numbers are real, what is the actual, what is the real picture as far as China goes. How do you look at the story for 2016? Do you think the concerns are overdone? Perhaps a lot more is out there in terms of information about China right now to make an assessment of which way the economy is headed?
So there's a big debate about really how fast it's growing and whether it's already had a hard landing. I think if you focus on the indicators that come from the heavy industry, state-owned enterprises and such, it does look very, very weak. But that's only a third of the economy, and 2/3 of the economy is service sector, retail, property, technology, and actually is very dynamic and is growing quite robustly. So we think that growth will probably be around about 6.5% next year. It's not going to be terribly strong, and there'll probably have to be some fiscal stimulus to keep it going. We actually think that the underlying growth rate, if it's all left to itself, the Chinese economy will probably grow at about 5% or something like that, which still isn't bad, but it does tell you that they are actually sort of pumping it up a little bit to get that growth rate. But they can do some more fiscal stimulus. They've also got monetary policy that they can use, and they've been cutting interest rates, and I expect them to continue to do that. So they've still got a few cards that they can play to keep things going. I think that the danger is that if you think about an economy that should really be growing at 5 and you keep saying it's going to grow at 6.5, you can get yourself in a difficult position where they get forced to do too much stimulus, at the wrong time.
And just elaborate a bit more on how the policy differential into 2016 would impact liquidity, global liquidity for markets, because you're going to be looking, as you stated, 2016 starting off with perhaps a rate hike, as the market believes, or into the first quarter there would be one, but the move there is towards tightening. The Fed is committed to that. Whereas on the other hand, you see the ECB, you see the Bank of Japan, you see the PBOC still extending out or supporting the economy with more QE. For that matter, even the central bank in Australia. In that sort of a differential policy environment, how do you see money flows, finding their way into different markets?
Yeah, well, I think the overall stance on monetary policy is still going to be relatively loose. I mean, of course, the Fed is the most important central bank, and the fact that they're tightening would mean a little bit of a squeeze. But we are looking at the ECB either announcing more or extending further. The Bank of Japan continuing to have to print in order to get inflation up to 2%. Those are important because they generate a lot of pressure on investors within those economies, particularly the institutional investors, the pension funds and insurance companies, who need to generate a certain rate of return. And because of the QE in their economy, they're finding that their sovereign bond yields have been depressed so much they have to start to go overseas to get that, and we see that a lot with institutions, and that means that outflows from Japanese yen, euro are probably going to continue, and of course that again tends to support the dollar a little bit more.
But my specific question there is essentially about how all this money supply will perhaps lead to a scenario, maybe not now, but into 2016, where you've already seen the US, the Federal Reserve, working on an exit plan, and perhaps other central banks just looking at cues within their economies to follow, to do the same, or follow the footsteps, because it's been almost 8-9 years. So the Fed led into the quantitative easing program. It led the world into the quantitative easing program. And it seems like perhaps with this exit strategy, it would lead the world out of it as well.
Yes, well, it will, but you've got to remember it's at least 2 years ahead of everybody else.
Okay,
that's the thing.
So that's not a 2016, 2017 story?
No, I mean, maybe by the end of 2017, it might be possible that the European Central Bank might be actually thinking of moving away from negative interest rates if they've been able to sustain growth. And I think there is a possibility of that. And similarly with Japan, but I mean, first of all, they would have to be slowing down their QE process. So it's a little bit further out, really, for both of those economies. They're just not quite.
So world markets will be supported by ample liquidity despite the US Fed looking at normalization.
I think that's right. I think you've still got all that liquidity coming from there, but we just have to you have to think about how those particular investors are going to react. It's not necessarily the same as when the Fed has provided liquidity.
What about the pain in emerging markets? We've spoken about China, but broadly it's been bloodbath for EMs this year, whether it's the currencies, whether it's the markets, EM debt as well. What's going to change for EMs?
Well, I think first of all, with everything in markets, things can only fall so far. Yeah. And commodity prices and a lot of emerging market currencies are very weak and at very low levels now, right at the bottoms of their ranges. So, and a lot of them are also offering very high interest rates. So they are they're beginning to attract interest from investors who think, well, maybe it's time to put on some carry trades. And so we could be through the worst now, and we could be at the point where we begin to see, as I said earlier, a little bit of support from the manufacturing sector, a little bit of growth coming through might be just enough to get the whole thing going again. But I think you've still got to be quite selective, because there are economies that, particularly the commodity-dependent economies, that will have leverage in those economies. Yeah. They could have problems with cash flow. If you cut revenues by 50% through the falling commodity prices, inevitably there could be some problems there. So investors are going to have to worry about default risk and stuff like that. But in general, they could begin.
Do you think there's still a very visible risk of an EM default in 2016?
Yes, I do. Yeah.
Where would that come from?
I think it would come from a commodity producer. Okay. Because that must be where the strains are being felt. Okay. A lot of the commodity producers do have big reserves. Right. So But
Brazil, Russia, these are countries which are being seen as an opportunity. Brazil perhaps not so much because of the political situation out there. But it's fallen quite a bit this year.
It has, yes.
The Brazilian real has been under a lot of pressure. Yes. So do you and the downgrades are there from the rating agencies for a lot of these commodity producers or commodity dependent economies. Do you think that these are the spots where there could be the risk of a default?
I would focus in those areas and also the areas like, if you're not seeing any signs of recovery in those economies, because they're all desperate for some growth to come through, which will help to support them. But
which are the most vulnerable markets according to you?
The most vulnerable, I think you'd probably look to Latin America. I think Brazil, there are a lot of questions about Brazil because growth is very difficult. We've got a lot of stagflation, very high interest rates, capital flight, and the commodity weakness. A lot of things are stacked up there, and it has been downgraded. So that's a concern. South Africa is a bit of a concern as well. Again, lack of growth, big dependence on commodities. Probably Russia less so, because they've got huge reserves and they're beginning to see some stability in the ruble. So. It's always, people always bracket the emerging markets together, but we tend to look at it country by country.
And do you think within emerging markets, the decoupling story would continue, that's each EM for itself and how they manage their problems?
I think so, yes. Yeah, I think until investors really come back wholesale, you're not going to get that kind of blanket buying of emerging that floats everybody.
And do you think that India, within that basket, it's been a year of it's been a mixed bag really for India. The market has stood out, but it's not outperformed in a major manner as it did in 2014. Ahead of the elections, and then once the government came into power. Does that change? How does the position in India look?
First of all, India, I think has improved its finances a lot since it was a member of the Fragile Five, and its current account has improved. It's a very strong and credible central bank, very good governor. And of course, it doesn't fit into that commodity bracket. So India is actually quite well placed for this environment because we're looking for a bit of stimulus on the manufacturing side and producing side, and so India could feed it off some of that and benefit from it.
But as you said, part of that story is already into the price. India has already enjoyed its luck because of commodity prices being low.
Well, it has, but at least it's not got the, what we're thinking about now is another phase where even if commodity prices stop falling, people will look at the finances and say of different economies, are we actually going to get repaid here? That's not an issue in India. Okay,
so then how do you map the India story from here? If we've benefited on the fiscal side, the macro variables have improved, growth has been largely stable, the currency has been largely stable, the markets have been in a range, not gone much, in terms of gains. Last year was better. What can we expect, to see for India in 2016?
Well, we'll get through the political problems first, and then if we see a bit of recovery in economic activity, we start to see, some of the PMIs beginning to improve because they've been on a downward track recently. If we begin to see a bit more growth coming through, I think investors will get attracted back into India, maybe initially into the currency, trying to play the carry. That will probably be the first place. And then, assuming that Modi can keep a grip on the economy and that there is a bit more growth, then it would probably be not a bad scenario for the Indian economy.
You spoke about political issues. Do you think that's still top of mind? Because we have a government with a strong mandate at the center. Yes, there's some wobbliness when it comes to their position in, especially the recent state elections. However, does that still raise question marks about political stability? Because that's been the plus that India has enjoyed over the last 18 months.
Yes, it has, but it's also about delivery of some of the promises that have been made, and that's what people really want to see. They actually want to see it following through, into better infrastructure and transport and reform in agriculture and so on.
And what about reforms such as GST, land reform? How much of your call to allocate more money into India hinges on some of these key reforms?
I think those are important. I think those are important.
Okay.
No, so you'd want to see those alongside some better growth. And if those things happen, then India is reasonably well positioned.
What kind of growth numbers are you expecting from India?
Well, we've had a little bit of a problem with the growth numbers because they changed all the GDP statistics.
That's true.
And nobody quite understands them now. So,
the government is talking about its potential being 8 to 10%. That's their ambition.
Yeah, we've got 7.8 at the the moment, but we are wondering whether just to trim that a little bit because, when we did that forecast, that was about 3 or 4 months ago, and the global environment might be a little bit softer now as a result. So it'd probably be 7.5 or something like that. That's the kind of forecast that we would be going for.
That's for 2016.
Yes.
Okay, and what about support coming in from the central bank? India has not been a classic case of where you're seeing the central bank easing to really soothe market sentiment. It's really been about saying here are the rate cuts that you need, and see if that works into growth. Do you think it would?
It will do slowly. I think it needs to be accompanied by a little bit of stability on the inflation side as well. But I do think, that will gradually come through. But it's not an economy that responds that strongly to interest rates alone. It would have to be affected by fiscal as well.
And you think on the fiscal side, the government is pretty much, managing its perception? They've kept to the target on the fiscal deficit. Yes, there's been, some adjustment here and there in terms of capital expenditure by the government. In terms of how they've, managed to keep the shortfalls in check. But largely, are you happy as an investor with the fiscal roadmap that's been laid out and how the government is managing it?
No, people are, and I think a lot depends on the GST and so on, and that's why this state election has been very important as a barometer and an indicator of whether or not they'll be able to carry through on that. But yes, I think people are, and of course, that adjustment on the fiscal side has been part of the reason why the current account has been improving as well, because the economy has increased its savings overall. So that's been very helpful, and that's fed through into the stability of the currency and the capital flows and so on. So it all fits together quite well if they can deliver that.
Okay, so as we wrap up, Keith, we've discussed a lot.
Yes.
Give us a big picture for 2016. Where is it that you believe directionally you would see allocations increasing in terms of either regions or asset classes. You've already spoken about how equities would perhaps be the preferred class to invest in. Give us a big picture for 2016.
I think the big picture is still one of the, although we've talked about the Fed raising rates and so on, it's still one of global interest rates being relatively low, investors struggling to find yield, very keen to start going into some of the value areas of the markets, which is where the emerging markets comes in, but also, staying more within the West, investors have begun to go back into some of the credit bonds, but what they really want, they're starting to look into property and things like that. So it probably means a continuation of a lot of the themes that we've had over the last couple of years. And it may be that as policy does stay loose, that we start to see more bubbles emerging.
Okay, but would if you're saying that there could be the potential of bubbles, are you saying that you would be cautiously optimistic about 2016, more so than 2015? How would you contrast the 2 years? Because 2015 was expected to be a year when we would see some clear signs of recovery. That hasn't come through.
No, the recovery has been much more patchy, and I think 2016 might give a slightly more consistent view. But I think the other thing is that investors have adjusted their expectations a lot. So at the start of this time last year, people were still thinking the US would grow at 3%.
Yeah.
Today, actually, people are saying, well, it's probably going to be about 2.5%. And I think if investors are a bit more realistic, then there's less scope to be disappointed. So
more scope to be actually rewarded.
Well, that's right. So, people have got that, they've got the setting on that now. And unless the US disappoints even more, then, that's not a bad backdrop.
So there's scope for outperformance in 2016?
Yes, there is.
All right, Keith, we leave it at that. Thanks very much for taking out the time to speak with us.
Thank you.
Well, with that, we come to the end of this edition of Global Market Outlook 2016.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.